Hello and welcome to Gemcast. We went out to 75 institutional investors and asked them a bunch of questions about their views on EM private credit. We're discussing this white paper, but there's clearly this sort of misconception gap.
Overall, the market outlook is very, very strong for emerging market private credit. 9% of survey respondents indicated that they expected AUM growth in emerging market private credit to either accelerate or stay stable in the next 5 years.
There is that gap between perceptions and reality. If you look at lower middle income countries, the default rate was 14.5%, whereas reality was to the order of 4%. It's pretty striking.
Bad news bias can overshadow the fundamentals. Investors were most optimistic about.
Hello and welcome to Gemcast, the podcast where emerging and private markets meet. In this episode, we're trying something a little bit different. We've got two guests instead of the usual one, and we're discussing this white paper, Unmasking the Potential, Navigating Opportunities, Myths and Strategies in EM Private Credit. I'm joined by Max van Bassbank.
Glad to be here.
And Pranav Khamar.
Thank you for having me.
Max is a director at Alpha FMC, who are the consultants that Gemcorp partnered with to produce this report. And Pranav's a portfolio manager within the team here at Gemcorp. So let's talk about this report, why we commissioned it. We went out to 75 institutional investors, right, and asked them a bunch of questions about their views on EM private credit. So Pranav, where did the idea come from?
Yeah, look, no, thank you. And first of all, thank you, Max, and kind of your kind of considerable team for all of the support and cooperation in putting this together. So, no, look, I mean, where was the point of origin of this? I mean, it's kind of the perceptions versus reality, right? Like, I mean, many kind of conversations we have with investors, there's kind of the recurring pattern that there's kind of some clear misconceptions versus what our lived experience is in terms of actually investing in kind of emerging markets, particularly in the private credit space. And so we thought, look, let's do something systematic here, because actually, when you look at emerging markets private credit, and we're pleased that the results kind of really aligned with expectation. Otherwise we may not be sitting here talking about them. Like, it kind of deserves to be set apart as an asset class from emerging market private debt, or from public debt, I should say, or DM. Developed market private credit. And yeah, look, I think it's been good to actually put that together systematically.
Okay, so we sort of had this hypothesis that we felt investors misperceived the asset class, and that's the feedback that you kind of anecdotally had, and you wanted to evidentially prove that. So Max, what were the themes that we saw then? What did you observe? What were the kind of key concepts? Evidently, it showed some of the truths that we wanted, but what do you think?
So we gathered some really interesting insights through our study. And so through that survey, which we issued through 75 institutional investors worldwide, and I think first and foremost, so, as Pranav mentioned, so there are some lingering misconceptions. I'm sure we'll get into them a little bit later in the podcast. But overall, like the market outlook is very, very strong for emerging market private credit, and investors are generally very optimistic, right? And if you look at some of the survey data we had, just to put that into context, 9% of survey respondents indicated that they expected AUM growth in emerging market private credit to either accelerate or stay stable in the next 5 years. And 51% plan to increase their allocations in the asset class, right? And this optimism makes sense, right? Because if you put it within the broader context of the opportunity, right? Because currently a very small portion of the private credit AUM globally is originated from emerging markets, right? But there's still kind of a huge financing gap in a lot of these kind of emerging economies, which banks, DFIs, governments cannot cover on their own. And our survey data shows that, right? Which is there is this unmet demand for alternative financing. And this is really shown to be the primary driver for this positive outlook.
Okay. And of those institutional investors, were there specific sort of demand pockets that we saw? I know it was quite a broad church of people that we spoke to. So were there specific clients who really like this opportunity and others who are less keen?
It's interesting you ask, because we sampled a pretty vast array of different institutional investors. We covered the whole landscape. But what our findings suggested is that insurers, endowments, and foundations in particular were expected to show the biggest increase in activity in this space over the next few years.
Okay.
Yeah.
insurance companies. That's one that we talk about in the office quite a lot. So
that's very right. Yeah. No, and it's kind of instructive that we're seeing this prospective future demand.
Yeah.
But that there is that kind of gap between perceptions and reality. One of the data points that really kind of struck me there was that when you look at the kind of the credit ratings of emerging market borrowers, and we're talking about here the subset of borrowers that are rated, which is a much smaller share versus the total universe out there, particularly within emerging markets. That actually, I mean, if you look at lower middle income countries, the rating implied that the default rate was something like 14.5%, whereas reality was something to the order of 4%. It's pretty striking, right? That's really, you have the rating agencies to kind of thank for that data, but it's kind of reflective of the broader industry. And when you think about particularly insurers and endowments, which kind of metrics do they look for in the absence of kind of anything else? And it's going to be those kind of credit ratings. And so, yeah, we're glad to have worked with you guys to kind of start to dispel these myths. And there's clearly more work to do for us as well.
No, for sure. And I think what I just add is with regards to insurance is the findings kind of confirm a broader trend which we're seeing in the market, and which other studies and recent surveys that have been published confirm as well, right? Which is insurers over the last few years have been gradually increasing their allocations to private credit, right? And part of that is driven by regulatory reforms that makes it easier for them to access private assets. But there's also just this constant search for better yield, for better liability matching, both of which emerging market private credit can help them deliver ultimately.
But the challenge being that there's this hiccup on investment grade, certainly for those that have pushed it from a regulatory perspective.
Yeah. So and then maybe not to talk our own book too much, but as
it's called Gemcast.
I mean, it is called Gemcast. Fair dues. I mean, in the same way that when we put a solution together on the asset side, so to speak, when we're proposing to kind of lend to a company or a government, we're also trying to adopt the same approach on the liability side, right? On the funding side, and actually looking at, well, look, how can we bridge that gap from the kind of the pretty interesting diversified portfolio of emerging market borrowers that we have, and actually getting that into an investment grade rated instrument or rateable instrument. Yeah. And there's some interesting work that we're doing there, which hopefully will bear fruit over the coming months.
Okay. So it seems like there's demand, there's interest.
Yep.
There are some challenges in terms of structures, but there's clearly this sort of misconception gap. That's something we've obviously spoken about in this room before. We had Felipe on here and he mentioned some of those things. So there's definitely that kind of theme that's running through it. But looking at the sort of asset class, and often, you can say, well, EM private credit, well, we say it's not one asset class, there's many asset classes, many markets. So was there a specific kind of area within EM where we saw more interest? Was it within regions, countries?
Yeah. No, it's a good question. And we looked at a few different lenses when we looked at investor preferences, like within emerging market private credit. And so perhaps if I start with strategies, right? The survey revealed that investors were most optimistic about, and I'm going to call them in order, infrastructure debt, direct lending, and senior secured loans. Distressed debts, local currency loans appear to be a little bit less popular within our sample size. And I think that with regards to infrastructure debt, kind of the attraction there kind of makes sense to the extent that, it's an asset class that has very stable and predictive cash flows. Importantly, those are backed by government concessions, very tangible collateral. And so there's a predictability which the investors will appreciate. In addition to that, there's an abundance of these opportunities across a lot of these emerging economies. And that means that managers also have the ability to be more selective, right? And to choose the investment opportunities and the targets that meet their criteria and deliver the highest value for their clients. From a borrower type perspective, respondents to our survey generally found that they had a preference for larger corporates. Now, there'll be a few different reasons for that. I think it is important to nuance this, that there are other managers out there that have been very successful in catering to the other side of the spectrum, right? Notably through kind of micro financing structures. So I think the takeaway here is that there is room for smaller borrowers where the model is right and where it fits, right?
Fine.
And then one point, which is on the regional preferences, where we saw some really interesting nuances as well, is the region that came on top of our rankings was Southeast Asia. I think about 78% of our respondents just actively invest in that region. But Sub-Saharan Africa is the region that came at the bottom of the list. And that's something which we discussed when we started this show.
Not overly surprised, but
No.
I mean, in to kind of turn it on its head, it's kind of, it really speaks again to the quality of the opportunity.
That's right. Yeah.
It's then no surprise that when we're kind of looking at working on a financing for a sub-Saharan African sovereign or an infrastructure project, we're not really running the race in a multi kind of 5 lender RFP process, right? We're pretty much sometimes in the only game in town, right? And then that affords us the opportunity to actually develop a solution that best aligns with what the borrower wants, but also what our clients want. In terms of a suitable investment and getting the right kind of underwriting standards and structure in place.
Do you think there's an extent to which some of the respondents kind of are happier transitioning into EM in ways that feels familiar? You know, dare I say, infrastructure debt feels like an asset class you can understand. You've probably done infrastructure deals in the developed markets. It sort of feels like the less risky end of the spectrum. And dare I say, of all the emerging markets, Southeast Asia is one of the easier ones to get your head around as well.
I think that's right. And I think there are, to your point, there are more general characteristics of infrastructure, for example, right? Which is the fact that, you know, there's low correlation with economic cycles. There's the fact that it's a typical, there's inflation hedging. It's used for a lot of these characteristics in developed markets. A lot of investors will look at those characteristics as well to kind of hedge against perceived higher risk potentially kind of in some of the emerging markets.
And that's and what makes, I think, something like infrastructure particularly interesting in emerging markets like those that we operate in, is that you actually can then look at situations where you have a pretty solid baseline return thanks to those contracted cash flows and government support and defensive kind of asset base. But then there's a growth story because, I mean, it's kind of linked to GDP, but the GDP, kind of real GDP, is growing at kind of in the kind of high single digits, perhaps even double digit context, right? So you get the kind of the best of both worlds, right? The kind of baseline and the upside.
Okay, so let's flip to this kind of misconceptions. Let's dig into that a little bit more, because that's a big part of this report. That's something that we talk about a lot. This kind of idea of this sort of misconception gap between I'm really interested in this, but I can't get over the line. And that's driven by this fact that we see, you pointed out, DM private credit, monster asset class, whatever, 1.82 trillion, and EM private credit 12 times smaller than that. So what were those misconceptions that the report came up with?
Yeah, look, and Max, maybe tell me if I ordered them in the wrong way, right? But I think the first couple that jumped out were really kind of expropriation risk and kind of political risk more generally. Fair concerns to start with, but actually as practitioners, we think they're quite manageable to structure around or mitigate. In sub-Saharan Africa, we haven't had a situation where we've had to deal with expropriation, right? Or a kind of a forced nationalization event or anything to that order. If we did, there's ways to actually mitigate that risk kind of upfront, right? You can buy political risk insurance fairly cost effectively, for example. On the other hand, I think there were some kind of concerns that were probably valid, but at the same time, there's kind of they're in the category where actually we can mitigate them quite systematically, right? So FX risk, for example, is pretty fair. I think that we're pretty used to kind of managing that, either kind of through the natural hedge of ultimately kind of lending to businesses that generate hard currency, such as exporters or kind of miners, oil and gas companies, for example. And on the other hand, kind of businesses that are defensive enough and have the right kind of inelastic demand that like, look, if you have an FX shock, they can kind of ride through it. Like in kind of telecoms or kind of other kind of close to kind of natural monopoly kind of situations. I think it's also worth mentioning that kind of on the counterpoint, there's also the misconception of problems that developed markets have that we don't, right? And One thing that kind of struck us was things like kind of lender on lender violence and these kind of situations that people kind of end up misadventuring into in kind of developed markets. I mean, when we're investing in a business, we're usually the lead syndicate member, sometimes the only lender. So we actually have a pretty strong degree of kind of control over the capital structure and how that evolves. And so fortunately we've not had to deal with that kind of a problem, for sure.
Where do you think these misconceptions come from then? I mean, they seem in certain cases they're slightly substantiated, but they're easily mitigated. What drives them?
I think it's a combination of factors. I think first of all, there is a fact, right, that there's a general lack of transparency and I think consistent data, right, and that's something which is true of like private markets in general compared to public markets. Probably applies a little bit more to emerging market private credit, just because of the fact that deal flow and performance data is going to be a little bit more fragmented, and that's also why we want to do this report, right, and contribute to it, is to kind of shed some light and bring some more visibility to the space. I think there's also, to some extent, some conflation perhaps with emerging market sovereign debt, in the sense that a lot of people will kind of look at headlines over the last few years and look at countries subject to sovereign defaults and liquidity crunches and inflation rates that kind of spin out of control, and you kind of have this bad news bias, which ultimately can overshadow the fundamentals, right? Because the reality is that across these economies, you have a lot of companies with really solid, dollar revenue, very healthy balance sheets, but they may get overlooked because of broader macro concerns, right? And then I think that the third thing is exactly what you were alluding to, Pranav, which is, I think you have these misconceptions or concerns around kind of risk and governance within emerging markets when it comes to creditor protection or when it comes to contract enforcement. And the reality is that, yes, these risks exist, right? And we shouldn't downplay them, but in many cases, they can be mitigated quite effectively through structured deal making, through local partnerships, and through the selection of managers who just have the right expertise, essentially.
I totally agree with that, and maybe just to add, I think some of the other things that it kind of tends to get conflated with are local currency, emerging market debt, and local law emerging market debt, of which we don't really do either. Frankly, and those are the kind of situations where you kind of do run into those kinds of hazards. Right?
Do you think that might be a little bit to do with that sub-Saharan Africa point there? I mean, because that is a region that does have a fair bit of currency volatility and does have some challenges in terms of sort of political stability and governmental change. And do you think that's a little bit drives into that?
Perhaps. I would actually be interested to look at the data of actually kind of the prevalence of governmental change in sub-Saharan Africa versus.
Am I guilty? I'm guilty there of doing it, you see. Home team as well.
Versus like, frankly, other emerging markets, right? But even developed markets, right? I mean, maybe I'm now stereotyping DM too much, but if I look at some of the kind of unprecedented political developments that folks have had to deal with in the kind of a developed market context, actually, when you look at some emerging markets, in some senses, is a beacon of stability. I mean, if we're talking Africa, I mean, you actually look at some countries that have actually been through pretty tough economic cycles, like Angola, where actually kind of historically the country has been quite sensitive to kind of oil prices. Actually, there's a pretty strong track record of fiscal consolidation. I'm not sure many countries in Europe have the same kind of degree of fiscal discipline, right? In fact,
yes. So, crystal ball time. We've done the research. We need to evidently educate investors. But what's your predictions for the future? How do you think this plays out? With our clients over the coming years.
It's farming, right? I think we need to kind of plant the seeds for us to change the hearts and minds. I'm mixing my metaphors here, but in terms of their outlook on kind of emerging markets, private credit, realizing that it's indeed a separate asset class that kind of deserves a bit of a different treatment to the adjacent ones, be that emerging markets public debt, emerging markets PE, developed market private credit on the other side, and like the shifting kind of factors in each of those other ecosystems don't affect what we do.
Okay. Max, anything else to add? It's not from the Gemcorp team.
I think that's absolutely right. And also, I think hopefully just emphasize and show that, there's a big advantage to this asset class, which is if you compare it to developed market private credit, you're at an earlier stage in the maturity life cycle, and there is a first mover advantage, and there's really something to be seized there. Yeah. And hopefully by, kind of lifting the lid on kind of some of those misconceptions, like in this report, and, delving a little bit deeper into what is an actual tangible risk and what can be mitigated away, that will encourage many more investors to really kind of venture a little bit deeper within this space.
Okay.
Because the opportunity is there. Yeah.
Good. So the first thing they should do is definitely read the report. So
absolutely,
if you want to go read the report, you can go to gemcorpcapital.com where you can find it. We'll also put a link in the show notes for this episode, which you can click on and access the report. Before I let everybody go, I just say congratulations to both our guests this week on Gemcast. So we have Max has recently celebrated his nuptials, so congratulations, Max. And Pranav has had his first child as well.
Well, following in your footsteps, a bit behind.
Yeah, well, I'm working on it. Yeah. So with all that, thank you for listening. If you want to find out more about Gemcorp Capital Services, then get in touch with your client relationship manager at gemcorpcapital.com.